Good evening, all the joinees. Thank you so much for joining in. Hi, this is Prajakta. I would like to warmly welcome you all on behalf of NGEN Markets. So before we begin, I'll just introduce our topic for today. So our discussion for today is going to revolve around comparing two portfolios side by side and generating reports out of them. So when we are comparing two portfolios side by side, first we will understand how we will load a portfolio. And when we load the portfolio, how we will optimize the portfolio using a improve function on NGEN Markets. We will understand what are the improve optimization models mean. So how are they categorized, ranking models and the value models, and understand the difference between them. Once we understand that, we will then move ahead and actually use our comparing two portfolios tool on NGEN Markets and see how we can highlight each and every parameter of those two portfolios side by side. So one, of course, is the very important returns performance parameter. Next, how does the volatility of the two portfolios differ by using the improve optimization model value or the minimum volatility as a model, right? We'll understand how the holding analysis changes when we improvise the portfolio and how can that be highlighted. And lastly, we will see how we can actually generate an actionable proposal for the client from this two portfolio comparison. By actionable proposal, we have, what I really mean is we have two options. One is a percentage based PDF and the second is an amount based PDF. So amount based PDF is typically for it to be more relatable for the client, right? So let us now delve in. Of course, after that, we will move on to the Q&A session. So let's begin the session. So when you typically go to the NGEN Markets terminal, we will typically be going on the portfolio section. In the portfolio section, I have loaded in a test portfolio for September for the purpose of this webinar. So I will just click on this drop down and I'll run this particular portfolio. When I run the portfolio, you will typically see that, okay, this portfolio has 8 components and these 8 components are so on and so forth. The asset allocation of the portfolio is 70% into equity, 23% is into debt, and the others is a cash exposure. Okay, the first thing that you will do is let's say we want to analyze this portfolio for, let's say, 3.5 year period. So the number one thing that you will do is you will go to the start date and change it to the period under consideration. So we are doing this from September, maybe January of 2020. So let's just put that as a start date. Once that is through, we will then click on improve option. So this improve option will actually suggest optimization models for the portfolios. As you can see, currently the portfolio is equally allocated to each of the component in it, right? All the 8 items are given an equal allocation of a 12.5% each. Okay, the moment I click on improve, what it is really going to do is it is going to hypothetically backtest the data from 1st of January 2020, because that was our start date, and it is going to throw up some optimal allocations. So now optimal allocations could be to achieve different objectives of the client. Okay, so let's first focus on the first column itself, which is the original allocation in the portfolio. So with the original allocation in the portfolio, 12.5% each, as you can see, the original portfolio return is a 18.61%. With the original volatility, meaning the standard deviation, of a 13.40%. And the Sharpe ratio of the portfolio, that is to say the risk-adjusted returns, meaning the returns that the portfolio generates per unit of risk that it takes, that's 0.86. So typically, higher the Sharpe ratio, better it is for the portfolio, right? So higher risk-adjusted returns, the better it is. As of now, it's not very bad. It's a 0.86. That's the current Sharpe ratio. Now, the first model, just concentrate on the ranking models. We are only focusing on ranking models as of now. And just see the first column here, which is rank returns. Now, what that is doing is, it is going to reallocate these same funds in such a proportion that the returns that are generated by the portfolio are optimized. Optimized meaning maximized in this case, right? So here you will see that the annual return from 18% has become a 24%. That's close to 6% jump in the annual return. So that means your portfolio had a potential to generate a 24.12% return if the allocations of the components in the portfolio would have been these. So what these optimization models are doing is they are not trying to add a new fund, neither are they trying to delete any fund, right? As you can see, the names of the funds are exactly the same. So we are not recommending any new funds, neither are we deleting any. What we are just doing is we are reallocating among the same funds in such a manner that the objective of the client, which is in this case maximizing returns, is achieved. So what we can typically see is this PGIM India mid-cap opportunities. From an existing allocation of a 12.50, it has been in this model been given an allocation of a 36.79%. That's the highest allocation if you see in this particular column, right? And why is that so? That's because this particular fund in the period starting from 1st of January 2020 would have had the highest returns, right? And that's the reason it has been given the highest allocation. The second highest, of course, you can see is HDFC mid-cap opportunities. The original portfolio allocation, as you are aware, is an equal allocation. That's 12.50%. However, the second highest allocation, which is 18%, is being given to this particular fund. And of course, so on and so forth for each of the funds to ultimately achieve 6% excess return or alpha over the original portfolio. Okay, that's the first model that is taken into consideration. Here, you can also see that the Sharpe ratio of the portfolio has substantially improved, more than 0.20, right? So 20 basis points. So from 0.86, it has improved to a 1.03. That typically means that the risk-adjusted returns of the portfolio have now improved, right? That's the first model, which is rank returns. Now, on the other hand, we have a minimum volatility model, which is to say that it is going to allocate or give a weightage of the maximum extent to that particular fund which has the lowest volatility. By volatility, we mean risk or standard deviation, if you may call. Right. So now, given the funds, even if you do not look at this allocation, it typically it's very easy to really determine that, okay, this UTI liquid cash and this Axis Banking and PSU debt fund, both being from the debt category, are going to be given higher allocations. And that is exactly what we can see here. Right. In order to minimize the overall portfolio volatility, it has actually given the highest weightage of a 36.79% to UTI liquid cash fund, right? It being a debt category fund, it will typically have the lowest volatility, and therefore the highest weightage is being given to this particular fund. Of course, second highest is being given to Axis Banking and PSU debt fund. And so on and so forth. This exact thing can be replicated and it actually can be corroborated using this Excel sheet that I have right here. So what I've typically taken is I've just exported all of the results of these particular funds. So these are the names of the funds that we have, 8 funds, right? And all of these 8 funds, first you will see the of course, the returns. We'll just come to the returns a little later. Volatility, right? In this case, these are the actual volatility numbers that have been clocked by each of these funds from 1st of January 2020, which happened to be our start date here. Okay. So what we can typically see is the lowest volatility is by UTI liquid cash plan, which is a volatility of a 0.29. That's just close to 0.30, right? Which is the least volatile or the least risky fund. And that's exactly the reason you can see the highest allocation being given to this UTI liquid cash plan, right? Now, let's go to the Sharpe ratio as a model. This third column, which is Sharpe ratio, what this is doing is it will give the highest weightage to that particular fund which has the best Sharpe ratio, right? So in this case, if we focus on only this third column, we will see that PGIM India Mid Cap Opportunities Fund, which has been given the highest allocation of a 36.79%. Okay, let's just go back to the Excel sheet and see actually does it actually have the highest Sharpe ratio. So if we just sort them to largest to smallest, we can actually see that okay, PGIM has the highest Sharpe ratio of 1.11, and that is the reason it has actually been given a weightage of a 36%, which happens to be the highest in this entire list. On the other hand, of course, the lowest weightage is being given to this UTI liquid cash plan, which is to an extent of 4.60%. And that's because it has the lowest Sharpe ratio. So let's just corroborate that quickly. It's right there. UTI liquid cash plan, it has the lowest Sharpe ratio, which is negative 8.83, right? And therefore, it makes sense that that is what is the calculation logic of these ranking models. Typically, when we consider the ranks, volatility, and the Sharpe ratio. Now, let's say you want to compare the test portfolio, meaning the original portfolio, with one of the optimized portfolios, right? Then what you can typically do is you can save these allocations. So let's say I typically like this particular model for an aggressive client that I'm trying to address, right? He does not mind taking in some extra risk if that comes with some surplus returns, right? That typically means a risk-seeking investor, right? Aggressive investor. So then what I will do is I will save these allocations using this save option. So test portfolio September and hyphen optimized. This is what this portfolio is going to get saved as. But of course, I can edit this. So let's say I want to save this as an aggressive model. So I will save this as, okay, aggressive. And I'll click on create. The moment I do that, this particular portfolio with these weightages has just gotten saved in the portfolio section itself. So let me quickly come there and show how it has gotten saved. So because we saved it from the improve functionality, you will see this portfolio saved under improve folder. You click on this and you will see that, okay, this was created just now, test portfolio September aggressive, right? When you click on this drop down and click on run, you will see the weightages that were really there in the optimized model. Okay, so PGIM being given the highest weightage, right? So this is once this portfolio is saved, we will then go ahead and actually compare its performance against the original equal allocated portfolio. Just before proceeding, let me go back on the portfolio and explain the value models as well. So when I click on run, again, following the same logic, changing the start date and clicking on improve. So the difference between the ranking models and the Sharpe and the value models is that value models follow a balanced approach. By balanced approach, what I really mean is they take into consideration the underlying numbers of each of the parameters to come up with those weightages. So for an example, just ignore everything except returns now. Just focus on ranking models, rank returns, and value models, returns value. Just ignore everything else. Okay, now we will see that in this case, when it comes to ranking models, it gives the highest allocation to PGIM India mid-cap opportunities to an extent of 36%. Okay, so typically what it has done is it has put all the eggs into one single basket. So tomorrow, if this PGIM India mid-cap opportunities does not perform well, 36% of your portfolio is into that particular fund. And therefore, the chances of your portfolio underperforming or maybe getting affected by the performance of one single fund increase manifold, right? And that's exactly the reason we have this ranking returns value model to rescue. So what this has done is it has again given the highest allocation to PGIM India mid-cap opportunities only, right? If you consider only this column now, in this entire allocation, so 3, 3.5, 3.15, 16, 18, 14, 20, 13, and 11. Highest allocation is to PGIM India mid-cap opportunities. But the extent of the highest allocation is a 20% only. right? How it has come to that is because it is considered the underlying return numbers that PGIM India had clocked in, right? So if we see on this Excel sheet, we will see that, okay, PGIM India has actually clocked in the highest return, which is 30%, but the second highest, that's HDFC, has clocked in 27% return. If you actually consider the value of both of these, so 30% and 27%, the return differential is only 3%. So actually, it should have actually given fair amount of equal weightages or maybe slightly higher weightages to HDFC versus PGIM. And that is exactly what the value model has done. Value model has said that, okay, PGIM has definitely highest return, 30% is what it has clocked. But HDFC is also not bad. It has clocked in 27% return. So 20 se to definitely it will give the lesser weightage, but 18% is what is being given here. On the other hand, the ranking models, what did they do? Okay, PGIM came first. Therefore, the highest allocation has to be given to this, and highest in this case is 36%. And exactly half of that, 36 ka half becomes 18%, which was given to HDFC. But in fact, if you see the actual picture behind it, you see that the return differential between these two is just a meager 3% differential, right? Similarly, if you see the difference between these two funds, right? Let's say this one, Axis Mid Cap and Aditya Birla Small Cap. The actual return differential is a 23% return generated by one particular fund, and the other fund has generated a 20% return. So 23 plays a 20, only 3% return differential. But in ranking models, if you see, this particular Axis Mid Cap has been given a 9% weightage. On the other hand, Aditya Birla typically has been, one second, let me check which one was that. Yeah, so Aditya Birla Small Cap, it was given a 20, it has got a 23% return, and the return allocation was a very high percent of a 12%. So 12% plays a 9%. So this was what given in the ranking returns model. On the other hand, ranking value has actually considered the underlying values of those returns and given a 14% to Axis Mid Cap. Also, it is given a 16% to Aditya Birla Sun Life Small Cap Fund. So it tries to follow a balanced approach rather than a concentrated approach, which is followed by these ranking returns models. Okay. Similarly, we can apply the same logic on this minimum volatility and the Sharpe ratio value model. So it will take into consideration overall a balanced approach. It will try to distribute the allocation in such a way that no single fund is given the highest concentration, right? So that's about the improvisation functionalities. Now, let's come to actually comparing two portfolios, wherein we have actually created a portfolio. For that, we will go to portfolio section and compare two portfolios icon. When you click on compare two portfolios, it will take you to two portfolio comparisons side by side. On the left-hand side, you will load in the existing portfolio, or in this case, the equal weighted portfolio. So our equal weighted portfolio had the name of test portfolio, September. The moment I load it, you will see that the allocation to each of the funds is an equal allocation of 12.5% each, 8 positions in consideration. On the right-hand side, we will load in the aggressive portfolio that we just saved, right? So we had saved it as test portfolio September - aggressive. I will load in this portfolio side by side. You will typically see that the names, the schemes are exactly the same. Positions, total 8 positions. But in this case, average position is also 12.5%. The maximum position is also 12.5%. That's the underlying weightages of the funds. In this case, however, PGIM has the highest allocation of a 36.79%, and that is exactly being highlighted here. Okay. Now, in order to make a fair, comparative performance, we were analyzing from January only. So let's just put January 1st, 2020 here as well. 1st of January 2020 and run. So now you can typically see that the annual return differential between the two portfolios, in spite of having the same components of it, is a 5.5% annual return differential over a 3.5-year period. right? So let's say this, you can typically see that the period under consideration is 1st of Jan 2020 to 14th of September 2023. The annual return differential is a 5.5% between the two portfolios. Of course, this orange line that you can see is representing the aggressive portfolio, and the green line is the equal weighted original portfolio. So if you want to highlight the original or the cumulative, absolute differential between the two portfolios, that's tabulated right here. Over a 3.5 year period, your equal weighted portfolio would have given you a 88% return. On the other hand, the aggressive portfolio with optimized allocations, it would have given you a 122% returns in this particular 3.5 year period. And that's an excess return of a 34%. That is being highlighted in this case. Now, if you were to see the annual return differential, which is, really mentioned here, that is exactly coming from this place, right? If we consider average annual returns, 18 plays a 24. That's a 5% excess return. Okay. With respect to volatility, of course, because we were aggressive in this case, the client is typically okay with taking in extra risk. And that is exactly what is highlighted here. Okay. Annual volatility of this portfolio is a 13.41, and the aggressive portfolio has an increased volatility, meaning increased risk of a 16.51, which is again highlighted here. So original portfolio volatility, so 13% plays a 16% risk. Of course, there's an increment in risk. And that is exactly again highlighted in the Sharpe ratio differential also. So Sharpe ratio differential of our original portfolio was a 0.81 versus the optimized portfolio has a Sharpe ratio of 0.96. Definitely improved Sharpe ratio. That typically means that the second portfolio gives a higher risk-adjusted return to the client. Right. After that, what we have really done here down here is the calendar year wise performance of the two portfolios side by side. So in this case, you will see that 2020 as a calendar year, if we consider, the original portfolio would have given a 21% return. On the other hand, the aggressive portfolio would have given a close to 28% return. Right. Similarly, for all the other calendar years till date. Of course, this is going to be till date. So till September of 14th. Right. After that, let's come to asset allocation. In this case, you can typically see that the exposure into large, mid, and small substantially changing between two particular portfolios. Right? We need to remember that the schemes are not really changed. Only the allocation has changed, and that's exactly what is being highlighted by this pie chart. Right? In this case, large cap has an allocation of 26%. On the other hand, in the optimized or the aggressive model, as we're really aware, large cap is restricted to a 20% only. Increase in allocation is typically from large cap or from small cap and mid cap. That is exactly being highlighted here. Right. Once this is through, you can definitely have a look at its rolling returns. In rolling returns, what we're really trying to say is a 6-month rolling versus a 1-year rolling. So 130 days, meaning a 6-month rolling. The average 6-month rolling returns of one portfolio, compare that with a 6-month rolling return of the new portfolio, that there's a 2% return differential. So 10% plays a 12%, right? And of course, the lowest return, right? In this case, our portfolio had a lowest return of a negative 11.67. On the other hand, the aggressive portfolio has a lowest return of a negative 14.64. Definitely, the chances that this portfolio can give negative returns has increased. And that is exactly what is being seen here. Because, of course, it's an aggressive portfolio, right? Once this is through, you can actually check this for any other models also. This is what we've built it for an aggressive model. I've already saved allocations for conservative client, which is, let's say he wants to minimize the volatility come what may. He is okay with compromising on some returns, but he wants the volatility to be the minimum. So therefore, I have saved in that particular portfolio as a conservative. And let me quickly load that up and show it to you. So again, you click on performance, you will see now the return differential is negative, right? But you will see the volatility between the two portfolios is reduced, right? This is the original volatility versus this is the new portfolio volatility. This is for a conservative client, right? And once this is through, what you can do is in after this analysis that you have done, you can actually generate actionable proposal for your client. Now, actionable proposal is, if you generate this into a percentage based, it will definitely be effective. But when it is an amount based, it will be more relatable for the client. And that's the reason we've given two options here. When you click on create PDF, there's an option that gets generated wherein you can put in the capital amount in rupees. So let's say this particular portfolio or this particular client wants to invest, let's say 50 lakh rupees in his portfolio. So what you will do is you'll enter the amount here. So 50 lakhs. Once this is through, and you'll click on go. A detailed 4-pager PDF is what is going to get generated here. So in this case, you will see that first page, of course, is going to be a detailed comparison, the way we were seeing on the screen, two portfolios side by side. Of course, this is a negative return differential, is because we are comparing a conservative portfolio with the equal weighted portfolio, right? So this is exactly what we were seeing on the screen, the top asset allocation, how much of it is into equity, debt, all of this is going to be there for the first 3 pages. And the actual proposal is going to be this page, the last page, right? Wherein what we've done is we've differentiated or allocated the capital or the AUM of the client on the basis of the percentages base. So you will see that equal allocation is being made here. So 6.25 lakhs each to each of the funds. On the other hand, on the right hand side, you can see the UTI liquid fund being given the highest allocation of a 18.39 lakh rupees. On the other hand, Aditya Birla Sun Life Small Cap Fund, which typically would have the highest volatility or the highest risk, has been given the lowest allocation, which is 2.30 lakhs. Right? And this is how it can act like an actionable proposal or an actionable plan for the client, even before executing any trade, right? So even before taking a position, even before exiting a position, you can actually highlight this for the client, right? Now here in this case, what we've done is we actually optimized our existing portfolio and compared it with a optimized portfolio. But you can actually build, let's say, a prospective client's portfolio. Let's say that client is not investing through you, through your ARN, but you can still onboard his portfolio using our statement analyzer option. Okay, you can use the statement analyzer option to onboard the client portfolio from his ECAS statement, right? So NSDL, CDSL, and CAMS ECAS files we capture using this statement analyzer. You can onboard the client's portfolio. Once it is onboarded, you can typically load that up on the left-hand side here. So let me load in the existing portfolio here. So this is the existing portfolio for September month. And on the right-hand side, you will load in the model portfolio. Typically, that will have the whitelisted funds that you would have done for the client. And you're trying to propose those schemes to your client, right? So you will load in the model portfolio here. This is the model portfolio. Again, using the same parameters, you can highlight, okay, look, if this was your portfolio 3.5 years back from 1st of January 2020, you could have generated 5.75% extra return on an annual basis. Cumulative basis, it could have been up to a 35% excess return. Again, you can take a dump of this into a PDF, as we were just showing, and actually generate an actionable proposal for the client. Right now, this is again one of the ways of doing that. Another way could be, let's say that existing client of yours or maybe a prospective client holds a stocks portfolio only, right? Does not have a mutual funds portfolio, and you want to make him convert to a mutual funds portfolio. So what you can do is you can load in an entirely stocks portfolio here. So this is a tool. It can handle anything. It could be a stocks portfolio. So just load in a stocks portfolio of the client. So let's say this is a stocks portfolio, right? And you can compare it with the model portfolio of mutual funds that you would have created for him and highlight the differences. So the capability is there. All you need to do is explore multiple options. So in this case, stocks portfolio is possible. Existing clients' current portfolio is possible versus a model portfolio. And again, you can highlight the drawdowns analysis. So right, in this case, we are yet to see the drawdowns analysis, wherein you can highlight the strength of the portfolio to recover from loss. In this case, on the left hand side, we have a stocks portfolio, which in fact, a drawdown or a loss period is still ongoing. It has not completely recovered that particular loss, right? So typically in typically in volatile times, the clients might get jittery, right? How long should they hold on to their positions in stocks, right? On the other hand, you can typically highlight that this mutual funds portfolio has not just recovered all of its losses, but the worst loss also got recovered in just 163 working days. That's typically just about more than half a year in terms of working days, right? So it recovered the entire losses. Of course, this is from a common start point of 1st of January 2020, right? The worst drawdown it has is of a size of 37%, right? And it recovers that entire loss in 163 working days. This is how you can say that, okay, look, this portfolio gives you a better recovery or better resilience in terms of volatile markets. That typically tells you the strength of your portfolio versus its existing portfolio. And you can highlight this analysis and then ultimately present this in the PDF manner like this, right? This is how you can typically present this. That's specifically about it from my side for the topic related webinar. Before we go ahead, I would just like to highlight that we have made a recent release wherein you can now customize the disclaimers that get generated on each of the PDF and the PowerPoint options, export options that you can make from NGEN Markets. So for that, you just have to come to this settings icon. When you come to this settings, there is a last option called as reports disclaimers, right? You click on this and you can actually put in a disclaimer of your choice. Let's say a RIA client has to comply with SEBI and specify some disclaimer, specific standardized disclaimers, right? So you can edit all of this. So this is a standard disclaimer that we have put, but let's say you have one of your disclaimers. So you can just clear all of this text and you can input whatever disclaimer you want. Once that is done, you click on update. Once that is done, all the PDF exports and of course the PowerPoint exports that you will make will have that customized disclaimer, right? Alternatively, you can definitely use a standardized disclaimer that we have given. And of course, this is also going to be editable, right? For that, just click on this. This is how is the existing disclaimer. And let's say you do not want this particular paragraph, right? You can remove this and replace that with any other requirements that you might have in your disclaimers, right? So that's possible. Once this is done, you click on update. And after that, whatever PDF and the PPTs you generate will have that specific page as a last page, of course, dedicated for disclaimers. That is one update that I wanted to share with all of you. We can now throw the forum open for a Q&A session wherein you can get your questions answered. You can do so by either typing in your questions in the chat box or unmuting yourself to speak. Thank you.
Hi, Prajakta. This is Pramod here.
Yes, hello. Yes.
Yeah. See, I am using NGEN for more than a year and all. And in one of the past sessions on the same, optimization, I was recommending that, we need to have a cap on the asset allocation. Like if you see your example also, the way the liquid fund was being reduced drastically to enhance the returns, right?
Yes.
So that would not be fair when somebody is looking at a asset allocation ceiling, right? So I want my client to have a 30% into debt and 70% into equity, and he is an aggressive client. So I want the optimization happening within these limits. So if the optimization is going to, dislocate my asset allocation of 30-70 and throw some recommendation, it would not be fair, right? So I had this discussion, long back, and I think that is something which needs to be considered.
Hi, this is Aruna. Yeah, sure. I understand the issue. Now the only thing from our side is obviously you're supplying the list of funds. So if there are a couple of liquid funds, for example, then that would we could probably use that to fill up a forced bucket of, let's say, less risky assets, or vice versa. Maybe if you have enough equity funds in there, we can use it for equity allocation. But the ceiling will have to be driven by the funds that you've provided us. Just to give you an example, for example, if you asked NGEN to give you a recommendation of list of funds where 30% is in equities, 30% in debt, etc. We could probably pick the right funds and fill those buckets. But for what you're asking in this particular portfolio, for example, it is, of course, it's taking away money from liquid funds to generate return. You could potentially look at the volatility suggestion, which will hopefully put a little bit more towards the liquid fund because of low vol. But if you're going to put asset allocation ceilings, then those ceilings will have to make sense in the context of the funds that you have selected in the portfolio. Because remember, this optimization doesn't add new funds or even remove any funds from your existing list. So in this case, for example, we have 8 funds. That's we have to work within that. In fact, you can see the minimum vol suggestion actually has most amount of money in the cash bucket. So I understand the issue you're facing. You're right, where it's taking away money completely from the liquid bucket while only chasing return. But what we could potentially do, I don't know if this solves your problem, but we can look at the funds that you have provided, see the kind of types of funds you have. If you have equity, debt, liquid type funds, and then within that existing set of categories, we can kind of let you have some limits and then work within those limits. But the more limits we provide, the fewer solutions we're able to get. So that is a problem that's inbuilt into any optimization process. So I know it's not really an answer to your question, but what you're asking, we can do it, but it will work subjectively in specific cases only.
Yeah, no, see, I think I'm getting the point, but most of the data, when you look at the segregation of the funds, right, they are classified already in the back end by NGEN, whether it is part of
Yes.
equity or debt or gold or any
Yes.
of them. Now,
Yes.
when it is already there, if you can just mention that, is there an option that the advisor wants to exercise, telling that you optimize it within the ceiling, or you are free to optimize it? Now, if it is within the ceiling, all that the application needs to do is they need to look at the weightages with each of the asset classes. So in this case, if you see, UTI liquid and Axis banking and PSU falls into debt, and the original rating is around, the percentage what is there is around 9 to 10% in the first column I see. But
Yeah.
when you start looking at the minimum volatility, it is going to 18.4%, and returns, if you look at it, it is changing.
Yeah, much lower.
Yeah. So my point is, I should be given a choice that the returns should be generated, not getting money away from my debt allocation. Does enhancing or changing? Yeah.
Understand. So here we will only obviously be able to provide you the choice of limiting ceilings based on whatever you enter. So for example, if you put all equity funds in a portfolio, right?
Correct.
Obviously there'll be no point in having any ceiling, right?
Yes.
So because this is a portfolio which seems to have some equity funds, some debt funds, we can give you the choice of having a ceiling. So okay, I understand. I mean, yeah, fine. We can take a look at we can try to take a look at this, and maybe we will provide that.
Yeah. And just one more query, slightly off this place. But when I am trying to do let us say I am trying to upload a cash for one of the client statements, and I am trying to evaluate the comparison, that data, when when it is showing the data, right, it is not allowing me to download it in the Excel. Whereas when it is my client data from the NGEN platform, it is taking it. Okay,
so when you get it into the statement analyzer, when you so this should not be a problem. So once you download this, once you upload your any cash statement, it will show up like that on the right. Now, at this point, you have not yet converted this into a portfolio, either in the portfolio section or in the client section. So
Right.
you need to first do that. So you could go to the portfolio section, and it's a simple process. You just go to add new portfolio, like there, and then basically say load from statement analyzer. So, and then you just click on that plus button. Project, actually, could you just do that again? Went through very quickly. Yeah. Okay, so we start a new portfolio and then load statement analyzer. You click that, and then you will see exactly the same view that you saw when we went to the statement analyzer. So whatever you've loaded and saved here, it will show up here. And you just click the plus button. It will basically take all the holdings from the statement and put them in here in percentage. And it'll put the name also. And then you just press on create. That now you got a portfolio here. Now it's just the same as any other. So she just saved it already. So now it's just the same as any other portfolio. You can run it, and after running it, you can download reports, Excel, whatever you want.
But when you look at the contribution or the performance, right? Just let us go to the performance.
Yeah.
And when you go down, you will find the funds. I mean, it's not showing here.
You're looking for contribution
Each
to performance?
funds.
Stats. Stats. Is that maybe it's a
Yes.
stats page, Projector? Yeah.
Yeah. So I am not able to download this in the Excel.
Okay. All right. No problem. Projector, let's just add this to the list of things to do. And yeah, we can definitely do that. This should not take too long. Next release, we can put this in there. It will obviously apply to any portfolios that we run in the portfolio section as well as clients.
Yes. Yeah. This was in the stats. Thanks, sir.
No problem. Any other questions? Please let us know.
Hi, sir. This is Karthik.
Hi.
Hi. So actually, I just had a question. So in this what this comparison we were doing the ranking and that two models. Can we go there?
Yeah.
So my query was like we have only given weightage to Sharpe and Sharpe ratio and what if we want to give weight to any other factor like say 3/5 rolling return or a Sortino ratio? So would that work here? Like, I mean,
Understand. Yeah. I mean, so no, okay. So I understand. So here, when we launched this particular improve section, it was kind of an experiment to see if people like it and if people are using it. So in that case, we only basically did 3 straightforward models with either the volatility or the returns or the Sharpe ratio, and then these 3 factors being used with 2 different ways. One is a ranking model, one is a value model. Now, as you correctly said, of course, there are many different ways to maybe improve these suggestions, which is to use rolling returns and other factors as well. So we haven't yet started any work in expanding this facility. But having said that, I think that can probably be one of the next.
Then we can maybe whatever factor we feel it is important, we can add weightage to it, and then maybe play along what's the actual optimal ranking model should be. Like,
exactly.
So that is what I want. And one more thing, if we can add numbers to it, that would be a good thing, because percentage के आगे numbers अगर हो तो then client actually feels कि इसमें से पैसा निकला है, इसमें से ज़्यादा हो गया, so then it kind of feel a rebalancing is happening.
So you mean like like a portfolio capital and then the
coming from the original like 12.5 say 5.26 हो गया, तो how suppose we have assumed 100 rupees we have invested, so 12.5 से वो मतलब कम हो गया 5.26 रह गया, मतलब that way.
Allocation. You mean allocation?
Yeah, allocation. But
okay.
जो percentage में change हो रहा है
Hello.
Yeah.
Yeah. Good evening.
Yeah, sorry. So we're just finishing one question. If you just could you just wait 1 second, we're almost done. So Mr. Karthik, yes, that's absolutely. In fact, Prajakta, I think one of the current tasks in progress is adding a capital sum to this so that they have a choice to view this as percentage or numbers, right?
Yes, yes, it is. Yes.
Okay. So Mr. Karthik, I think that one is already in progress. And in terms of adding other factors, yeah, we can start looking into that. One thing that might help you is that we are almost finished with a long-running project for creating fund scores. So we are expecting to release that this month. And there you will actually see a score between 0 and 10 for every fund within its category. And then you'll be able to, the next step is you can combine these scores. They'll be based on 1 year, 3 year, 5 year return, 1 year, 3 year, 5 year sharp vol, etc. And you get an overall risk and return score as well. That's basically kind of to create a sort of ranking system or a customized ranking system on your own.
Right. So
But
similar thing like is happening here, right? So
yes, exactly. Very similar thing is happening, and that obviously can then be adjusted. That ranking, that scoring model method can be adjusted to actually just simply create good equity or a good debt portfolios just by picking the best ranked funds, right? And maybe using them as a weighting scheme. So so we're getting there slowly. But the amount example, the amount question you asked, that's definitely being done.
Okay. And so last thing, sorry,
Yeah.
I'll be quick. One more, sir. In this we are rebalancing, right? So
yes,
when we load a fund, there's a large, mid, and small cap is given, like holdings in large and mid and small, like 80.
Yeah.
So what I'm saying is, can we just like add this into this rebalancing thing whenever we change the how the allocation is changing, like 70-30, just like sir said. So what when the rebalance comes, so what is the allocation which is being changed now?
So we can show you how your change will affect the large, small, mid cap allocation.
Yeah.
Now, will you provide the new portfolio, or the new portfolio is coming from this improved calculation?
Maybe I can load the client's portfolio and put the model portfolio, like what funds I need
next to it. So you want to show how it will change.
Yeah, how the allocation will change.
Okay, so here there is one way you can already do it, which is the portfolio compare section.
Okay.
So if you've got both portfolios saved, the kind of before and after, right?
Okay.
You can load them on here, left and right, and here you'll be able to see literally side by side. It prints out in the PDF report as well.
Okay.
You can see how the market cap on the left has changed. So it prints like this.
Okay.
So here you can put anything. You don't have to put two portfolio. You can put a portfolio as it is today, and on the right hand side you can put the portfolio that you propose that they go to. So then you can print this report saying, the left side is where you are, right side where I'm suggesting you go, and with my suggestion, your market cap allocation will change like this. Your sector allocations will change like this, etc.
Okay, right. Thank you so much.
No problem. Sorry, I believe someone was about to ask a question. Can you please go ahead? Just a few minutes ago, someone was about to ask a question. If you're still there, please, if you could go ahead and ask. If there are any questions from anyone, please just let us know.
So there's one question in the chat box which says, can we use disclaimer for stocks suggested portfolio as well? Yes, of course. So any portfolio that you would have, you generate a PDF or a PPT, this disclaimer will come, right? So let me just quickly show a stocks portfolio. This is a stocks portfolio I have. I've loaded this. The moment I click on PDF for the PPT option, it will come with a disclaimer, right? irrespective of the fact if it's a mutual fund portfolio or a stocks portfolio, the disclaimer is going to come. Right? The last page.
Any other questions, please let us know. Okay, if there's no other questions, Prajakta, we can close off for today.
Yes. So thank you so much for joining in. Please check out our YouTube channel for checking out our past recorded webinar sessions. You can just click on the YouTube channel. You can see that on the YouTube button that you can see on NGEN Markets. It will take you to our YouTube channel, and there's a dedicated playlist for webinars and also short videos. Right? You can definitely check out all the past recorded webinars, 80 plus videos already uploaded. So you can definitely have a look at the past webinar recordings. So thank you so much for joining in. Have a great weekend ahead. Thank you.